Alrighty, everyone, welcome back to the Rare Petro podcast. Today, another market report card for you. So last time we did Chevron. If you missed that episode, I'll be sure to link it so that you can actually get filled in. Other than that, periodicals on the website as well. Yeah, we've got the written version, lots of tables and figures there too, so you'll probably want to go there for the best understanding. And while we're at it, you probably want to watch it on YouTube if you're just listening to the podcast. We're going to be throwing out lots of figures, lots of numbers. Definitely going to be easier to watch. So be sure to not only subscribe to this content, but to follow our podcast, periodicals, and everything else through LinkedIn and rarepetro.com. But like I mentioned, today's financial analysis is Oasis Petroleum, so let's get right into it. Oasis Petroleum Incorporated is a U.S.-based upstream and midstream E&P company with a focus on developing onshore unconventional oil and natural gas assets. The corporation is publicly traded on the NASDAQ Global Select under the symbol OAS. At the end of 2020, Oasis's exploration and production segment held 401,000 net acres in the Williston Basin and 24,396 net acres in the Permian Basin, with an estimated 152 million barrels of oil equivalent net proved reserves. On May 20th, 2021, the company announced the sale of its Permian assets for $481 million while acquiring 95,000 net acres in the Williston Basin for $745 million. The transaction has now made Oasis a single basin operator focused on its assets in the Williston. The company's midstream segment manages natural gas, oil, and water, gathering, transportation, processing, compression, disposal, and distribution. Oasis was founded in 2007 and exited Chapter 11 bankruptcy on November 19, 2020. It is currently headquartered in Houston, Texas, and that's pretty much what you need to know for the company profile. Now for the financial analysis. Due to the company's restructuring because of Chapter 11 bankruptcy, a quarterly financial ratio analysis was performed between Q3 of 2020 and Q1 of 2021. As of March 31st, 2021, Oasis Petroleum reported almost $2.3 billion in assets, with about $1.3 billion in liabilities and $962 million in total equity. During Q1 2021, the company generated $339.2 million in total revenue and a net income available to shareholders of negative $43.6 million. A peer comparison was performed for the last 12 months, with the quarter ending March 31st, 2021. The companies chosen in the comparison were Continental Resources, Whiting Petroleum Corporation, and Enerplus Corporation, all of which have a large focus on the Williston Basin, so good competitors to compare with. Based on those three competitors, their averages were calculated for several different financial ratios to create a benchmark for Oasis. The main cross-sectional performance indicators that stood out for Oasis were average collection period, receivables turnover, profit margin, return on assets, return on equity, and price-to-earnings ratio. For the asset management ratio's average collection period was 62.9 days, which is below the competitor average. This also ties in with the higher receivables turnover ratio than the competitors of 5.8. These ratios indicate that Oasis is taking less time than competitors to collect revenue and is more efficient at collecting payments for goods sold. The profitability ratios for Oasis are mixed compared to its peers, as the ROA is much lower, negative 109.4%, while ROE is much higher, 228.3%. The PE ratio for the last 12 months was also high at 34.4, while the other competitors were all negative. This data may be skewed by several factors affecting both Oasis and its competitors. Oasis and Whiting both exited Chapter 11 bankruptcy in 2020, which may have an impact on the PE ratio from restructuring debt and creating a new equity valuation. For the same reasons, the ROA and ROE may not be as accurate of a metric for comparison over the last 12 months. Profit margin was also very high at 57.5% compared to the negative average of peers. This margin is surprising since over the last 12 months, commodity prices have severely damaged oil and gas revenues. Based on the company's income statement, it appears that a line item for other unusual items of $837 million relating to net organization items and non-operating income expenses may be the main driver in this unusual profit margin number. When comparing the financial ratios from Oasis to itself over the last 3 quarters, the inventory ratio and times earned interest, or TIE ratio, stood out in Q1 2021. The inventory turnover ratio has increased in the most recent quarter, up from 7.3 to 11.5. This is likely due to demand for crude increasing over the same time. The TIE ratio has been poor because EBIT over the last 2 quarters has been negative. This is likely impacted by the impairment of oil and gas and mineral property following the bankruptcy exit in Q4 2020 and a net loss on derivative instruments of $182 million in Q1 2021. Following the sale of Oasis's Permian assets, purchase of additional Williston Basin assets, and offering of $400 million in senior notes in Q2 of 2021, the company has been making many changes each quarter to its balance sheet and income statement. A balance sheet common size analysis shows net property, plant, and equipment decreased 5% between Q4 of 2020 and Q1 of 2021, while current liabilities and long-term debt changed by 7% and -3% respectively. Following the recent transactions made by the company, a significant increase to property, plant, and equipment can be expected, as well as a large portion of long-term debt from the $400 million in senior notes to be issued and drawing on the company's existing credit revolver for the purchase. The income statement index analysis shows the company has been generating a gross profit since exiting bankruptcy, but has also had a large increase in cost of goods sold and operating expense during the last quarter. Due to the bankruptcy restructuring, the amount of interest expense has decreased significantly, but this number should continue to be watched in the coming quarters to see how it is impacted by debt taken on for the Williston asset purchase. The company has also hedged a fixed swap volume of 29,000 barrels of oil per day at $42.09 a barrel and a two-way collar volume of 8,000 barrels of oil per day with a 51.25 floor and 68.24 ceiling through the second half of 2021. Following the divestiture and acquisition, this constitutes about 75% of the company's oil production that could be affected by these contracts. An analysis of several performance metrics benchmarked to competitors of Oasis, ratio comparisons over prior quarters, and common size analysis on the balance sheet, and an index analysis of the income statement were all performed. Recent company transactions, including the sale of Permian assets for $481 million, an all-cash purchase of Williston assets for $745 million, and the $400 million offering of senior notes at 6.75% that occurred in Q2 of 2021, are not represented in the most recent financial statements. Following the company's exit from Chapter 11 in Q4 of 2020, Oasis appears to have a better average collection period, receivables turnover, and PE ratio than its competitors. Its ROA, however, is significantly worse than the competitor average. Many of these ratios from data over the last 12 months may be skewed by low commodity prices and the restructuring that occurred from bankruptcy. When the company's ratios are compared to itself over the last 3 quarters, inventory turnover ratio has been improving while the TIE ratio has been negative due to costs associated with restructuring. Following the recent asset divestments and acquisitions by the company, the next quarter can expect increased net property, plant, and equipment on the balance sheet, as well as additional current and long-term liabilities. The result will increase the company's debt leverage, which should be monitored in the coming quarters to ensure debt obligations are met. Assuming commodity prices continue to rise, the company should still see increased profits compared to the past several quarters, but will likely also be missing out on some additional revenue from hedging contracts in place through 2021 and 2022. But I think that's about all you need to know about Oasis, and from a very high-level financial analysis anyway. Well, I shouldn't say high level. We do get into the nitty-gritty, and if you're trying to look at the nitty-gritty, again, these are uploaded to rarepetro.com, where you can also find the Chevron one as well. So, plenty of information to have, plenty of data to sort through. You don't need to wait for me, so I'll let you get to it. This has been Tavis Killian with Rare Petro, and until we see you next time, take care, everybody.